Hey everyone, I have a special show for you today. This show is meant to help you protect yourself, hopefully prevent you from getting burned. I actually brought back a friend who's been on the show many times, and we're going to talk about private money. He and I have borrowed millions of dollars in private money. We've structured deals with win-win. This really came because this guest and I both have seen articles recently with bad actors doing bad things and burning limited partners and private money investors, and that's not okay. So let's welcome Tom Staub to the show. How you doing, buddy?
Good. How's it going?
It's going good. It's holiday season. We're recording this on Christmas Eve. We're gonna post this on Christmas Eve. Really is a gift because you and I both have experience in high tech in the Valley. We both talk to real estate investors, some that want to be active, right? They want to flip or they want to buy and hold. But I don't know, half my conversations are with people that go, I'm too busy and
Yeah.
I just want to be the bank. And unfortunately, what we've seen over the last 2 or 3 years is it was pretty easy to, frankly, be horrible investors, but make a decent return because the market was going up. Guess what?
Yep.
The market's going to flatten out. I think there's particular parts in the commercial segment that are going to be disastrous. And
Oh
if
yeah.
you're not careful, there are about to be a lot of money investors who lose most, if not all, their money. So I think we need to talk about this, how to protect yourself going forward. If you're in a deal now, what to ask, because I think that's stuff. So why don't I turn it over to you? I know you use private money a lot, just as I do.
Yeah.
So why don't you kind of share your initial thoughts and we'll go from there.
Yeah. And so just real quick, right? I use yes OPM or other people's money for my things in Arizona that I'm doing. Development, land up. So bigger deals. I have my own little portfolio of passive income, if you will, driven by these private money lending deals.
Mm-hmm.
But over the course of probably 5 years, I've been involved in more than 150 deals uh, with my own or my clients' money. And just this past year, we did 81 deals with a total capital amount of around 4.9 million. Right. So
Wow.
we've seen a lot of deals go through our table. We've only had two scares across all of the deals, and partly because of I think what we have in place to ensure that our risk is low, the returns are stable, and the teams execute on the deal.
Yeah. So you've put it out there. So when you say you had two scares,
Yep.
well, what does that mean?
Yep. So, early on in my, I guess, investing with OPM or hard money lending, I didn't understand the importance of team. Right,
Mm,
team is by far, I think, the most critical piece of the equation.
for sure.
And back then, I was willing to give my money to really anyone who had a hammer, as long as I was getting my
Yeah.
payments right.
Yeah.
And what you come to realize, and one lesson that I'll share with your listeners, and probably the most important lesson, is that the experience of the team and the size of the team is probably the most important part of the process.
Yeah. Yeah. What I would
Right.
tell, yeah, I think I mean, so I'm not, so again, right, this is just always an open book on this channel. I've taken millions of dollars, probably upwards of 8 to 10 million dollars over the course of time, paid it all back, except I think I have half a million out right now. Most of that will be paid off by the end of January because they're just flips that are in the process. Maybe February 15th. Um, but where I was going with this is one thing I don't do, and I know others do, is I don't mix capital. That's just a non-starter for me. And that means that Mike Zuber will never syndicate because sure, I could go raise millions of dollars probably within 48 hours, certainly 72, get $1 million allocated, and then I could go search for multifamily. Um, that's not exciting to me. That's not something I will ever do. But how I structure my deals is okay, I find that value add asset. I'm going to use someone else to buy it, and then I'm going to come in and put my money at risk first. Um, Now, I appreciate that that's not for everyone, and very few people have the financial backing to do that. Because again, I'm putting my risk capital is up first in that model, but I just sleep so much better at night. Um, so why don't we talk about syndications? Because I think that's where the most pain is coming. Where hey, I'm one of
Yeah.
50 investors in a $10 million fund, and oh, by the way, you know, this is what's going to really, this is the unfortunate part. This is my third deal with this operator. And oh, by the way, the first two were great. And now all of a sudden I'm in deal 3, 4, and 5, and they're all going bad. That's what's about to occur because you were conservative in 2017 or 18 when you could not do wrong. And now you're in 3 deals and they're all going bad. So let's talk about his syndication. That's, like that.
Yeah, I mean, I think you're spot on, right? There's a lot of headwinds that are hitting that syndication market. And when you think about your traditional, I mean, to say the least, when you think about your traditional syndication as of late, last 5 years, it's been residential, commercial buildings, right? So 20, 40, 60 plus units, usually purchased in a D or C class area, which means, crime ridden, lower income, with the hopes of turning it around to a B or A class.
Yeah,
right?
every perspective I saw was value add,
Yeah.
value add, value
That's right.
add.
Yeah, and it's great on paper, right? And I think if you assumed all conditions were to remain the same, which they're not, and people wanted to stay in these small apartments during COVID, and they wanted to pay extra for the A and B class, then I think you're all great. The problem is, as you know, that's not happening. The C and D class will probably remain C and D class, and the ability to raise rents, which drives the valuation of the building, is not going to exist.
Yeah.
Now, the problem that we saw with Grant Cardone this past year and other operators or syndicators, they have the right to hold back distributions.
For sure.
Right. And that's one of the biggest risks, I think, in syndications. You don't control your cash flow.
Yeah.
Right?
And again, I would tell you what Grant Cardone, you brought his name up, and other fiduciaries did in like April, May, June. They should have, right? Their number one job is to protect the asset. Right. Their number one job is not to pay distributions. So this is what I think is happening right now. So a lot of syndicators from the big boys all the way down took a pause March, April, May, at least March, April. And then they're like, oh, this is not so bad. What we didn't realize, or they didn't realize, is the Fed just basically gave out a bunch of free money. And now that's running out. Savings are down, payments, because I saw it just in my little portfolio, right? My personal portfolio. We were running great through November, then December hit. Not so great now. So my prediction is syndicators, especially folks, if you have a syndication in a C class area that you were hoping to upgrade to a B class, value add, and your deal was interest only like 2018, 19, 20, you are about to stop distributions again. I'm guessing you stop it by February, if not January, because rent collections are down. I mean, I talked to another big syndicator who's got market data, and they were running about 95% collection. Now they're in the low 90s. And you add that on top of vacancies, you're not paying distributions. It's just mathematically impossible.
Yeah. You were talking to Dana from Hemlane, who I use too on my products. She's pretty ear to the ground on collections. What did she say in terms of what she's seeing right now?
She is saying that collections in single family homes are the segment, are strong. And I would agree with that. My portfolio is about 60-40 units to homes. In my homes, they're fine. I got one guy who's been playing games since the very beginning, but that happens. But homes are great. People will fight to stay in a home. Once you are, again, I've done this for 20 years. Once you graduate from an apartment to a house rental, you never want to go back. So you invite your sister, your neighbor, your boyfriend, your girlfriend. You house hack, right? Essentially, you share the burden, and that's happening, and that's okay, right? Rent gets paid. But yeah, multifamily collections is down across the board, and C class is the worst. C class is in some parts of the country is in the 70s, and I promise you, you could have a building free and clear and not be able to maintain the building with rents in the 70s. That's how bad it is. It's getting pretty bad.
Yeah, and this is why I've been saying, back in August time. Yes, there's a wave of foreclosures coming, but it's going to be in the distressed property class, so C and D class. I don't think you're going to see a lot of B class foreclosures, or even A class, really. I think you're going to see a lot of.
Well, let me push back on that, because I think.
Yeah, sure.
So technically, you're right. You're not going to see foreclosures, but you will see operators switched out, because there are plenty of syndicators who are new that got a deal that was IO that now is in technical default. The bank's going to come in and audit them. They're going to realize they don't have the reserves and have zero capabilities to raise capital. And they're going to go, you know what? you're out. We're going to choose a new operator, one that we have a track record with, one who has bandwidth or a bankroll, and they're going to swap them out. They're going to give them a discount and it'll be over. So technically that will never be a foreclosure, but a general partner can get swapped out. When you are in technical default, the bank makes the rules.
Yeah. So what's interesting though is I'd be curious to know how grave and how quick banks do that. I just did a podcast recently about my prediction of the commercial crash coming in March or April, and I didn't know this, but basically when you look at all commercial loans, half of them are given out by banks. And when you look at those, even a level deeper, when you look at small banks, the small local banks, they're 2 to 3 times more concentrated in these commercial projects. And they're at a great risk. Yeah, they're at great risk of a massive bad debt hit to their balance sheet. So even digging deeper, I think the big banks will probably not start calling on their loans necessarily. It'll be the small banks that are in trouble that need to ensure that their assets, are stabilized.
That's interesting because I actually saw that in 2010, right? What people don't really realize is the last crash, the Great Recession, whatever you want to call it, it started in housing. But as the years went by, multifamily, i.e. commercial, was impacted. So I picked up 50 units for 0 down, like 3 different multifamily assets, all of them distressed. All of them had been, beaten to shit because the last operator couldn't perform, but they were all from small banks, all from small, 2 branches, like local city banks, or like not city banks, but local county banks, right? Like, I'm not going to name names, but I think that's coming. I think, by the way, they're very flexible. Like one deal I bought, they gave me a discount on rates. All I had to do was put $25K away for reserves for 6 months of repairs.
Oh, wow.
Which was fine. Deal's done.
Yeah.
Another one, they whacked $100,000 off the loan that the last operator had, took the interest rate in half. And I had that deal done in like 10 days. I didn't put any, I think I paid for processing fees or something. So when a small bank, what I'm saying is when you get a relationship with a small bank and you're a proven operator, they will bend over backwards for you because they want that shit off their books. They don't want it.
Oh yeah. Yeah. But my fear goes back to the small first time, syndicatee or investor.
Yeah.
They pony up, they wanted their 12% interest, or I guess cash flow. And now they're like, this building's going upside down.
Yeah.
So there's a mess coming to a lot of those newbies.
They're going to be wiped out. So, I mean, let's just play. So syndication wasn't a thing in 2010, but it just as easily could. So what is a syndication? You are basically an equity investor. So again, I picked up 50 units that had equity the day they closed, but guess what? Through bad operating, through a recession, through rent reductions and vacancies, the building couldn't operate. The bank took over, which immediately wiped out all equity. Gone, zero. Not like pennies on the dollar, like zero. And that is coming.
Yep. In fact, if it were me, and this is my opinion, and if I had invested in 18, 19, or 20 into a syndication in a C or D class with the value prop sort of strategy, I'd be going right now to my syndicator trying to get my capital back as soon as possible.
Yeah, and I would even I would take a discount, frankly, at this point.
Yeah.
Right. The first person out is going to be the winner. It won't be the last.
Yep.
So there's a couple of things I would dig into, right? Because again, I don't want to bash all syndicators. I mean, there are probably more than half are great. I don't know. I've never done one. I'll never do one, but I'm worried about the 30%. I mean, we just shared a Facebook post with a local Bay Area syndicator who was a bad actor. And I think there's more of that stuff coming. And I guess what I would ask is, I would call up the general partner and I would say, first, what's the debt structure? Basically, what's the payment? Is it interest only? Because a lot of deals were getting done the last 2 years only because they look good on paper because of the interest only period. If your deal looks bad, fully burdened, meaning principal and interest, trouble, because that IO period is going to reset in 1, 2, or 3 years. So that's question one.
Yep.
2, I would ask about reserves. How are your reserves, right? Is there a pile of capital there where you could take a 3 or 4 point hit on vacancies and a 5% rent reduction, right? Second, what's the worst case scenario? Can you keep this? Like most people go into a syndication hoping to be cashed out in 3 to 5 years. I believe, like you, we're going to have a problematic period. So what happens if it's a 6 to 10 year hold? Can you do it?
Yeah.
Right? Because I think that's going to happen. And again,
Well, and
yeah, go ahead.
And, you know, and think about, you know, when they were proposing this, you know, the return to you, it's based on the lifetime of the project, which was probably 3 to 5 years, to your point, probably three, most likely.
Yeah.
Now that it goes to 10 and you get the same return over a 10-year period. So your return on your investment is probably 3 to 5%, if it even pans out.
Yeah. Well, the problem is you're already in, you're pregnant at that point.
That's
you're
right.
done. Right. So I guess there's a couple of words of advice. This is one of the things that I still speak at real estate meetups. You know this because we've done some together. Is I go there, I try to provide value, but what I'm looking for is the questions after I'm done. And we did one about, oh God, it's been a year ago probably now, where like every other question was, I'm a brand new syndicator. What market should I go to? And that stuff scares me. I mean, you're going to really take your friends and family's money, and you've never syndicated, you never lived in this market.
Here's a deal too. Just this past year, the requirements that the government put on syndicators, they pulled back on. So it's even easier now to start a syndication. To be an accredited investor is easier now. And so the process to qualifying who can invest in syndication is easier than ever. So
this is where I go with this. What I would tell, so first off, if you're quote unquote pregnant, meaning you're in a deal, you need to go figure out, basically you need to call up your person over between Christmas and New Year's and figure out if that deal is going to go boom. Bad news doesn't get better with age. If it looks bad, I would offer to get out with a discount because again, last person out loses, first person wins, gets the best deal. I'm not saying you have to get out of all of them. If you're in a hot market like Atlanta, perhaps, probably the worst case for you is you hold for 10 years versus 5, probably.
Yep.
But there are some markets that are just toast. Then the second thing is if you're going to go into a new syndication, do yourself a favor. I believe most people go into syndications because they're not confident in their own behavior, their own knowledge. Right? I'm going to invest with so-and-so because they spend hours and they know all the vocabulary and they've done a deal. Build some confidence. I call it learning the market, learn the skill, because it's not that hard. And I just wish more people had confidence in themselves.
Yeah. Yeah, that's fair. You know, I'll end on one topic that I use in all my deals, right? I analyze all these different variables in a deal and measure the risk upon that. One of the key ones that I look for is what is the upside to the syndicator or the borrower, right? If the margin's tight and you're investing in that deal, any sort of, you know, wobble, any sort of headwind could turn that deal upside down, right? So invest in deals that have massive margins. I mean, it's not that hard to do. If they're promising a 15% return over 3 years, not fantastic. 30, 40%, there's enough room in there that they can make mistakes. There can be complications and you still come out ahead. So it's when, and to your point earlier, most deals in multifamily, 18, 19, 20, they don't have big margins. They're very tight projects. And so that's why there's risk. They're over levered. They don't have enough room to make mistakes. And so if you're in one of those, I'd be questioning what to do next.
Yeah. And let's be very clear. One last topic. We both know there are people trying to raise their next round right now, right? They're trying to do deals in 2020 or 2021. Because again, why? Well, cost of capital is really cheap and you can get an IO period for 3 years. And, oh, by the way, we're going to have a roaring 20s and, you know, you're not earning anything with savings. But folks, please do your homework first. Don't getting into a new deal now where cap rates are so compressed with so much variability in the future is maybe not the best option.
Well, it's bananas when you can find a syndicator that's picking up hotels or, you know, commercial buildings for mixed use at, you know, 30, 40% discounts, with massive margins. You know, like that's where the money is being made right now. Build to rent, commercial distressed assets, and hotel pickups. That's where it's at right now.
Totally agree. Well, I'll tell you what, since I got you, Tom, I want to wish you a happy holiday. Where are you taking your business in 2021? I'm just curious.
Yeah. So big things ahead. So we had the excavators on the land, plowing away all the beautiful
Nice.
pine trees. So we have a second project going on in the same area of Williams, Arizona, and then 2022 will be we're hoping to do a much bigger subdivision out in Arizona.
Nice.
So that's going to keep going. We're continuing to build out our client base for the private money deals. So that's going well, and we'll just keep trucking along.
Very cool, man. Well, have a wonderful New Year, a Merry Christmas, and keep doing what you're doing, buddy. Take care.
Likewise, thanks.
Uh-huh.